Hello and welcome to LAT's Weekly Market Insights. As we run up to the Christmas holidays, trading has been dominated by the action-packed economic calendar, with rate decisions coming from Europe, Asia and America. Now we can see here that economic calendar, it is red across the board, and it was the Federal Reserve that got us going on Wednesday. Jerome Powell first out of the blocks, and he maintained his Fed funds rate at spot 2.5% and announced that it was going to double the pace of its asset purchase tapering to $30 billion per month, which will double again in January, with similar reductions expected each month thereafter, concluding in March. Now, more importantly for traders around this announcement, Fed Chair Jerome Powell managed to avoid the potentially hawkish curveballs. No comments spooked the market or sent any real shockwaves through the market, which could easily have been expected as we came into this rate decision. As we come across to the dot plot, new projections for rate hikes looks like 3 rate hikes to be penciled in for 2022. This is a revision up from the 1 hike that was penciled in back in September. Now, this more hawkish tone, it has been largely priced in, and as we've seen, equity, there has been some equity downside of late, dollar upside of late as well. Really, we saw that dollar upside start to come in at the midpoint in the year when Jerome Powell first started to take a more sort of hawkish tone and start to use the buzzword of tapering throughout his statements. And of course, supporting this decision was an uptrend revision of inflation to 2.6% headline PCE by the end of next year. Now, the initial market reaction was pretty knee-jerk lower on the statement release. Before then, we started to see a bit of a risk appetite intensify. The statement perhaps not being as hawkish as some has feared. A hawkish sentiment, as mentioned, has already been sort of largely priced in. So markets took a positive tone off the back of still there is an expectation for inflation to cool down, whilst the jobs market is expected to improve. We can see that when we come across the charts. We can see the S&P 500 here coming off of that 50% fib retracement, forming this double bottom formation before breaking through the neckline on the announcement and on a pretty rapid charge up towards the previous highs. And these highs have held really back from the 22nd of November, big strong resistance level, like many of these indice markets, failing over this past couple of days post that announcement at this major resistance level. And interestingly, we've seen that more hawkish tone step back in. We're seeing the equity markets underperform again as we run through into year end, and now we're back trading pretty much where we started, back to the neckline's double bottom, just holding slightly up above this monthly pivot point. Now, Super Thursday lived up to its reputation, with the BOE providing a rate hike from spot 1% to spot 2.5%, which is a 15 basis point rise. Now, traders hadn't forgotten. They were somewhat sold down the river in November, and were hedging their bets for this rate hike. So whilst we saw a reaction, it's a pretty similar story to the Fed. It'd been largely priced in, and we did see the initial, again, a knee-jerk reaction and a move higher. With only one of the MPC members dissenting, it was a unanimous vote with the current underlying inflationary pressures. The MPC expects inflation to peak at around 6% in April. And if we come down to the charts, we can see just back onto euro dollar here, the initial dollar strength before then dollar weakness following through. But again, trading largely trapped within a bit of a range here now, longer term range still holding firm, and potential moves down into 11,300 round number as we look towards to close this week out. But coming back into cable here, we see that initial spike higher. There was a push higher on that data release, but it quickly reverted back to technicals. We've got previous lows and highs holding here at 13,350. 61% fib, monthly pivot points, all holding and pegging cable down. And ultimately, we're just seeing a resumption of dollar strength as those more hawkish tones start to catch hold again. And now looking ahead for the UK, of course, and for globally, Omicron clearly poses an element of uncertainty to the rate outlook in the UK. The first rate hike is now, of course, out the way, and markets will rapidly start to look at and assess the potential for another 25 basis point hike. Moving on from there, then, we came into the ECB, and Christine Lagarde, as expected, remain on hold for now. This had already been signalled by the ECB. They've also signalled previously that purchases under PEP will discontinue at the end of March 2022. The decline in monthly purchases as of Q2 2022 gave the release initially a more hawkish tone. And at the press conference, Christine Lagarde noted that although there are near-term headwinds, activity in the Eurozone is expected to pick up strongly in 2022. Unlike some of her counterparts, Lagarde has less fears and concerns regarding inflation, as they still have some nice projections looking into 2023-2024 of 1.8%. So all on track there, although still some concerns, of course. Now, with the Fed and the ECB and the Bank of England out the way, the main risks heading into the year-end have been removed. Moves in the markets are likely to be driven by year-end flows. With quad witching today, JP Morgan have provided expectations for a shift of around $210 billion out of equities and into the bond markets. Now we can see already the S&P 500 moving lower. Leading the way lower here, really the underperformer is actually the tech sector after a phenomenal year in 2021. And we just see strong selling off this level. And it's not a huge surprise. As we said, money flows towards the year end. It has been a record-breaking year for equities in 2021. And we see the increase in selling pressure quite clearly here. We broke this previous low back through here, and every time we came back to this level, we intensified, again, selling off more aggressively, breaking that low. So when we came back to these highs, little surprise, we've come away from it again. We are trying now to break down through these lows and look for a move down towards the 15,600 kind of region here to maybe close out the week for the NASDAQ. Okay, and of course, that movement JP Morgan alluded to, a movement away from risk assets into the more safe havens, into bonds. We can see down here the Ultra Bond. It's been a beautiful run here, strong support level. This level has held from November. December it's held multiple attempts. We saw shooting stars and hammers again back towards the tail end of November. And since then, it's been a straight upward run. Little roadblock ahead for us here now. We've got the monthly pivot point. We've got the round number here, big round number. So expectations for perhaps a slight pause, but we can see that clear shift and money flows moving away from those risk assets. Those having had some successful years, looking to close out the year, put some profits in the bank and move on and look forward towards 2022. So as we draw towards the close of an action-packed week, there's nothing left for me to do, but on behalf of the team here at London Calumet Trading and from myself, I'd like to wish you all a wonderful Christmas and a happy new year, and please do join us in 2022 when no doubt there'll be some more trading opportunities and some charts to be looked at.